Hello, ladies and gentlemen, and welcome to the CFG second quarter recap and our outlook for Q3 2020. This year has been one heck of a roller coaster so far, and honestly, we don't think the ride's about to stop. There's been a lot going on between coronavirus and unemployment levels and all the geopolitical risks, the oil war, etc. And volatility has remained a major focus, even though right now it seems like there's a bit of complacency in the marketplace. I'm going to try to run through this a little bit quicker, streamline the data points, and make the delivery easy to understand. If you guys have any feedback or any questions you'd like to shoot our way, send them to info@cfgfinancialplanning.com. And if you'd like to schedule your quarterly review, reach out to our office at your convenience. All right, so first up on the list, as always, we're going to talk about the U.S. stock market. We've had a major recovery, but it's only kind of supported by the data so far. We have this chart right here that's going to show our major indices. What you're getting here in the blue is the S&P 500. That's kind of the core index that most people look at. The orange line is the NASDAQ. You'll notice that that is essentially gone through the roof over the last couple of months. And then the red line is the Dow. The difference between these, the NASDAQ is super tech heavy. S&P 500 has a wider blend, but a little bit more tech heavy. It's also market cap weighted. And then we have the Dow, which is just going to be essentially the 30 blue chippy stocks out there that kind of represent multiple different sectors of the marketplace. The NASDAQ has dramatically outperformed the S&P and the Dow so far this year, but what's interesting is only a handful of stocks are really driving that recovery. Based on the tech index's performance relative to the others, I bet you can guess which stocks those probably are. I think all of us use them on a regular basis, and the fact that we've been kind of locked at home for an extended period of time makes us slave to our computer a little bit more than usual, along with the remote working environment becoming something of a regular occurrence. Even though people have been allowed to go back to work, a lot of people have decided to stay home and continue working remotely. While this was one of the most prolific V-shaped recoveries we've ever seen, our research suggests at this point that things might get a little dicey in the fall. A lot of this has to do with the data that we've talked about in our Thursday Thought videos, and one of the most important things to look at probably is GDP at this point. We estimate that the actual quarter-over-quarter recovery for second quarter was stronger than analysts expected. So the tweeter-in-chief actually was right about something for a change. If you take a look at this chart, we're showing a 27% recovery quarter over quarter. That's the projection, even though the numbers aren't out yet. This is from one of our research outlets that we use on a regular basis to help frame our macro strategy. This is essentially the largest bounce on a quarterly basis on record. By opening up the economy super aggressively, as well as limiting some of the social distancing requirements and some of the restrictions in particular states, we've been able to see a GDP recovery faster than anyone really expected. The challenge with that, though, kind of leads us to our next point, which we'll get to in just a second, is the coronavirus has come back with a vengeance. We started to flatten that curve, and we've been tracking this thing religiously over the last few months. And you guys have seen kind of how things have or were improving while the country was essentially on lockdown. And now we are in a situation where everybody opened up. A lot of states opened up very, very rapidly, and the numbers are not looking pretty. What we did here is I threw the coronavirus cases per day on the top here. In the middle, we have tests administered per day, because a lot of people are saying, hey, we only have more positive cases because we have more tests. And then the last one is deaths per day. I'd say the most promising thing out of this entire chart is the deaths per day have gone down. This is something we were tracking very closely and talking about how important it was or will be to see what happens, because there is a lag time, right? It generally takes anywhere from 5 to 10 days from contraction for people to show symptoms and then be tested positive, and then another week or so to 2 weeks if people are going to be hospitalized, and then another week to 2 weeks if they were in fact going to die. The one positive we're seeing right now, even though we haven't made that full cycle since we've seen this huge bump in cases, is the fact that the death rate has not increased precipitously. I think one of the major issues we're struggling with really hashing out is how aggressively are state governors going to re-shut down their states, or are they just going to let this thing play out in hopes of herd immunity? We see shutdowns occurring across Texas, some of the southern states, and then shutdowns also occurring in California again. This is going to affect GDP, which actually goes back to the point we were trying to make, that we expect lower than consensus expectations for GDP in third and fourth quarters. This is driving our macro strategy right now and also guiding our asset allocation in client portfolios. That's why we have a higher cash position than usual, because we're still cautious, because ultimately we have exposure. Right, we have exposure in the marketplace. If asset prices continue to increase, we're going to participate. We just don't see this as the all-in type of scenario. In terms of international markets, I think one of the things we want to look at first is going to be the European Union. Similarly to the United States, there were very aggressive stay-at-home orders, and businesses were ordered to close right at the first spike in coronavirus cases. Obviously, Sweden did things a little bit differently, but we're not really going to get into that today because I don't think it's relevant based on the size of their overall economy. But by and large, the EU has done an admirable job, suppressing the virus. I mean, they've been able to flatten that curve and keep it low, even with the increased testing that we've discussed. The economy has definitely struggled across the region, though, and this was something that we had touched on towards the end of last year and also in the first quarter, that things were getting less bad, but the virus definitely set things back. There's no doubt about that. The chart that we have in front of you right now shows some of the major economies in the European Union. We have the UK, Germany, Italy, and France. At this point in time, Germany has recovered relatively well. This is going to drive a recovery in neighboring countries as well, and we kind of expect that the continued weakness in the euro has been good for trade and will continue to be good for trade, especially as the dollar is strengthening right now. Demand has been a little bit weak, especially for manufacturing driven countries and export driven countries such as Germany, but like I said, that price discrepancy and the weakness in the currency has played to their advantage. Right now, we are seeing continued struggles in the UK. This is primarily due to the fact that their curve has not flattened as much as some of the other countries. They also have that overhang of Brexit being essentially unresolved at this point, which is just confusing people and creating more and more uncertainty, which we all know that markets certainly do not like. Moving over to China, there is a lot going on there. I don't want to spend an enormous amount of time because there's a lot of smoke and mirrors with their accounting practices. We've seen quite a bit of fraud coming out of some of their U.S. listed companies over the last few months, and it's been concerning to say the least. What we do know is their GDP recovered reasonably well, but it's not one of those all-in buy scenarios when we're thinking about that economy, because we honestly don't really know what's happening there. Right now, they are essentially re-tightening the screws on Hong Kong. There was an agreement in place that was supposed to allow Hong Kong to remain essentially autonomous in terms of government and policy, as well as their financial markets. We all know that there's been puppet leadership in Hong Kong, but at least the financial markets have remained fairly capitalist in nature, and that is changing as we live and breathe. We don't really know how that's going to play out long term. We just know that a lot of trade partners are kind of reneging on the special treatment that Hong Kong was getting. U.S. actually led that charge by removing the special trade agreements with Hong Kong, and they're essentially treating them just like they're a part of mainland China now. It is likely, in our view, that will slow growth and slow outside investment, and it is a bargaining chip moving forward for the administration, but we just don't think that necessarily anything's going to get done before the election, given all of the strife and struggles here at home. I alluded to the strength of the US dollar kind of flipping. We're on a very long bull market for US dollar strength. I have a 3-year chart here for you guys, kind of showing that slow grind higher in the strength of the dollar versus a basket of other currencies. This chart actually is specifically comparing the dollar to the euro, the yen, and the Australian dollar, and the British pound. So a lot of the major currencies, the one that's notably missing is obviously the yuan, and the thought process behind that is that doesn't really free float in the marketplace like other currencies do. It's our view that the perpetual stimulus in the United States is contributing to this weakness. This is a major driver of our base case for stagflation moving forward. Just to reiterate, that means that we have really, really slow growth, or even negative growth, perhaps, with a measure of inflation. Normally those things would go together, not in opposite directions. So that's why it has a unique name that not everybody's heard of. And generally it's not great for an economy when that is occurring, because people don't necessarily have as much money in their pockets, but things have a tendency to cost a little bit more. So it's challenging in terms of consumption here in the United States. And if you guys have followed the videos in the past, you know that our GDP is comprised of roughly 70% domestic consumption. At this point in time, we think that this dollar weakness is going to contribute to potential strength in emerging markets. And although there can be inflation associated with that in consumables, energy, foodstuffs, etc., that are all denominated in dollars, it does allow emerging markets an opportunity to service their debt more cheaply on a relative basis. And that's a big deal because they need to leverage themselves to build out infrastructure and to put them in a position to try to catch up to the rest of the world. So there are opportunities in emerging markets, and we're continuing to explore those. And it's likely that they'll pop up in portfolios. We're just not super excited about China particularly because of all of the convoluted politics and geopolitical risk specifically associated with that country. So be on the lookout for potential additional EM investing in the portfolios, because there is a good risk reward scenario presenting itself right now. Along those same lines, let's kind of go through real quickly what our general positioning looks like across the board. For review, this is not a cookie cutter scenario. This doesn't necessarily apply for every single client's portfolio, but our general positioning kind of looks like this. We have a slight underweight to US stock, and that's kind of been a function of us selling out winners over the course of the last few months since our market recovered very rapidly, and then also not necessarily reinvesting back into US stocks, but keeping that in cash. International equities are about neutral, but on a relative basis compared to where they have been in the past, it's probably slightly overweight to what you're used to seeing. EM is still neutral, but like I said, very tactically, we're going to be looking for opportunities in that space. Fixed income is neutral to overweight because it remained relatively stable throughout this process. In some things like municipal bonds, for example, although they went down quickly, they recovered very, very fast and have gotten back to essentially full value from where they were about 6 months ago. Cash is overweight across the board. Thought process is cash is king, right? That provides us an opportunity to take advantage of a potential market correction that we see coming in the fall if we are correct on our GDP expectations. Now, once again, for review, not everybody is seeing the same asset allocation. This is just our general positioning. And if you guys remember, my favorite phrase is data dictates positioning. I will never waver from that. That is my MO. If you guys want to hear more about how the data flows on a weekly basis, make sure to check out the Thursday Thoughts video. It'll be coming back next week. And I look forward to seeing you all there. That's live at 4 o'clock on Thursday afternoons. Once again, appreciate you all so much for watching these videos. I hope this was a bit thought-provoking, got the wheels spinning a little bit. I'd love to have reviews and talk about this in more depth, and then also dig into what could possibly happen in the elections coming up here in November. It's going to be a wild ride, but we're here for you guys, and we're always available to answer questions. If you have any questions or you'd like to reach out at all, shoot an email over to info@cfgfinancialplanning.com. Thank you again so much for watching, and stay safe and enjoy the rest of the summer.